Hi, we're joined by Erhan Gurses, BI's Telecom Analyst, to talk today about Vodafone. Erhan, Vodafone's share price reacted pretty positively to first quarter results earlier this week. And that comes on the heels of probably one of the worst performances within the telecom sector so far this year. So what do you think is really driving that subdued sentiment for the company? And what do you think it'll take to rebuild confidence in Vodafone's fundamentals looking forward? Can we say that the worst is over following the first quarter results?
Thanks, Rod. A struggling turnaround in Europe is basically at the heart of Vodafone's woes. The fierce competition in several markets, such as Italy and Spain, have been dragging the top line for quite some time. But Vodafone's key operation, Germany, has also been in doldrums due to a mix of operational issues and weak commercial execution. So a disappointing fundamental performance coupled with limited progress with M&A actions to alleviate the underlying issues have been basically behind the weak sentiment for the company. Vodafone trading at the bottom of key peers on forward EV to EBITDA and EV to operating free cash flow really tells the extent of that disappointment. Can we start building some conviction for a better outlook? I think we can. The company has reset the expectations with current year guidance, calling for flat EBITDA, which will set the stage for profit and free cash flow growth in the midterm. And now there are a number of elements that can support an improving outlook. First, Margherita Della Valle, the new CEO, is addressing the key challenges in the consumer segment, which are low customer satisfaction and lack of agility in commercial execution. Second, the carrier is reallocating resources to units with stronger growth outlooks, such as Business Arm, which grew by 2.6% last year compared to the slight decline in Europe. And let's not forget the carrier is taking measures to improve profitability, cutting 11% of its workforce in the next 3 years, helping offset a new profit headwind in Germany from cable TV regulation. We also think CapEx risks are manageable for the company. Its mobile networks across Europe have competitive positioning on quality, while fiber investment risks in Germany look low after recent improvements to cable network. So if Vodafone can execute on its strategic priorities well, a gradual improvement in the outlook is looking likely, which clearly would bring with it a sustained shift in the sentiment too. And in fiscal 1Q, we started seeing the first signs of this. Germany delivered on revenue improvement with relatively limited subscriber deterioration from price hikes, while Europe returned to organic service revenue growth after 3 quarters of contraction thanks to broad-based improvement. So Vodafone is not out of woods yet, but 1Q indeed showed the company is moving in the right direction.
And of course, the company announced a merger of their operations in the UK with Hutchison Three. Is there any antitrust considerations we need to make alongside that announcement?
This long-anticipated deal is definitely a welcome move for Vodafone, and it basically consolidates the UK mobile market by combining the third and fourth largest carrier, creating a leader with 33% market share in the retail segment. So with that, of course, comes significant antitrust review risks. Now, the deal will be reviewed by the local competition authority, CMA, which, if we look at in the past, has been quite strict against consolidation-driven deals, voicing strong concerns, for instance, back in 2016 to the failed merger between Hutchison and O2 in the country. But we think there are a number of factors that can support an approval this time around. The most important of these is the fact that the local telecom regulator, Ofcom, has concluded that both Vodafone and Three lack the scale to earn their cost of capital. And if this is sustained, it could lead to lower investment. That could push CMI to strike a more careful balance between the sector's investment needs and the consumer welfare, especially when we consider the multi-year 5G investment cycle we are in. Competition concerns over a merger may also be favored for this deal, as Vodafone's large B2B operation means that its consumer mobile subscriber share is of just 18%. So in the consumer segment, a combination would just maintain a third carrier with a larger 31% market share. Finally, yes, the UK consumers are coming under the pressure of inflation-busting mobile price increases, but Ofcom found in a recent study that compared to large European peers, standalone mobile prices in the UK are low, which may work to lessen CMI's concerns about the pricing impact of a deal. So we think the odds of an antitrust approval is higher, and that brings the question whether there will be remedies or not. Given the significant change in the market structure, the odds for remedies also look high. The antitrust review is expected to finish by late 2024, so it will be interesting to see developments on this front.
Erhan, thanks very much for your time. We'll keep an eye out for the catalysts in the future.
Thank you.